Jason, we're going to put you on the hot seat. You've heard the requests, and...
I will disappoint you, I'm afraid. The role that shareholders and investors can play in this is actually quite limited. And so I'm just going to walk through a couple of the reasons why I think that is. So first is materiality. Is inequality a material investment portfolio risk? And in most cases, it is not. And when I say materiality, what I mean is does the way a company conducts itself in terms of inequality, does that impact the share price or the bond price? And in the vast majority of cases, the answer is no. So if new information comes to the market around this issue, generally you're not seeing a big movement in the share price. Often the greatest risk that we see in this area is reputational risk for companies, and some of the other speakers have talked about this. So if you're a retail type of company, then this is a very real material risk for you. But if you're a miner or an oil and gas company or a company that sells to other companies, then that reputational risk is not really there for you. So that's a large part of the market that we deal with. It's not retail based. However, it is one of a range of ESG issues that we do look at. And so when you look at inequality in the context of the overall ESG practice of a company, it may be material. So it by itself, it may not be, but when you look at it in aggregate with the other ESG risks you're facing, it may contribute to material ESG risks within a company. And time horizon matters as well. So if you're a very short-term investor, if you're a day trader, this is not a material risk for you. But if you're a pension plan with a 40 or 50-year time horizon, this is actually becomes more material over time. The way we approach these types of risks is we look at them what we call on a contingent asset or liability basis. So really what this means is that if a company has poor practices now in order to boost its bottom line, that actually creates a liability. It may be a non-financial liability now, which in time will actually become a financial liability. So for example, with BP, long before the Deepwater Horizon disaster, BP had very poor employee safety and environmental compliance record. So they were boosting their bottom line by cutting costs on those line items. And then eventually that contingent liability became a financial liability when the Deepwater Horizon exploded. So even though these are not financial now, if a company has poor practices over time, it runs a much higher risk of that becoming a hit to our portfolio. I guess the flip side of this is there's not actually many tools in our toolbox if we did actually want to influence the way companies work, address this issue. So two of the tools that we do have is proxy voting and engagement. So we would support, for example, enhanced disclosure and standardized disclosure in this area, and Lisa's talked about this. And what that does is that allows us to assess the risk and understand how the company's managing that risk. We would also encourage companies to adopt better policies and practices in this area, so something like a living wage standard. We would encourage companies to do that. What we wouldn't do is we wouldn't support a shareholder proposal that required that. So we much prefer companies to work out the best way to address these issues themselves rather than having shareholders tell them how to do it. And what we'd actually never do is divest from a company simply because of inequality issues at the company. We would much rather engage, and because of the lack of materiality, we don't see it as a divestment issue for our portfolios. Another point I'd just like to make is that often this issue, it's lumped together with executive compensation, and that does tend to muddy the waters a bit. We do consider executive compensation to be a very material portfolio risk, but it's a very separate and distinct issue from inequality when you look at it through the lens of materiality. So generally when we see shareholder proposals asking, for example, a CEO's compensation to be compared to average employee compensation or average household compensation, there's not actually a lot of value in that for us. So it's not new or useful information that we're getting when that kind of disclosure is undertaken. That kind of disclosure can be difficult to calculate, especially for global companies, companies that are operating globally. And again, data quality is an issue which Lisa's talked about as well. And what it may actually do with this kind of disclosure is in order for a company to have a better metric that they're disclosing, they may actually get rid of a lot of those low-paying jobs that they have and outsource those to companies that actually have worse practices. So it may actually have a negative consequence opposite to what you would intend. And the final point I'd just like to make is that I think good corporate behaviour is not a substitute for good governance. So the best way to address inequality is through national and international government action. So things like tax policy, employment law, health and safety regulations and social programs have a much greater influence on inequality than anything we can do on the corporate side. However, things like corruption, lobbying by companies, a lack of infrastructure, these can have an impact on government's ability to take action on inequality. So as investors, we should be talking to companies about disclosure around payments to foreign government officials, which has just been rolled back in the US. Lobbying, full disclosure of lobbying payments, of lobbying activity and lobbying payments. So those, as investors, are things that we can hold companies to task for, and this is actually valuable disclosure for us. So I think overall, I don't think it's an investor's role to be lobbying governments on social policy, but that doesn't mean that we can't hold companies to task on certain aspects of that. So that's everything I wanted to cover.
Good, thank you. And I think there will be some follow-up questions on that, I suspect. And I will say Jason is being very brave to come up, and we're very appreciative. He, as you can imagine, it was great of him to be willing to come up here and to help us represent this point of view. So let's bear that in mind. Now I've made you nervous, Jason. Damon, for a counterpoint.